Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. As always, I'm very excited to be here with all of you. We're approaching the end of the year, and obviously the holidays have just started. So as we start to approach the end of the year, I think it's very important to take a look at the tax planning that perhaps many of you have already done. Most of you more than likely have not done any tax planning as of today, but at least you still have a little bit of time in which to be able to do so. One of the things that I want to talk about today is why I think that taxes are going to have to double in the very near future. And I'm going to walk you through some of the debt and the liability that we have in our country, because I think the more informed you are about these issues, the better decisions that you're going to be making for yourself, your families, and your business as you start putting money away toward retirement and obviously upon reaching retirement. So if you take a look at the national debt, and many of you have been reading some of the stuff that we see in the news media today regarding the national debt, we're actually approaching $22 trillion in debt, in the national debt. We're actually at $21,780 billion, and that equates to about $178,000 per taxpayer in the United States. Something that is very interesting to note is, although the debt continues to increase, many of us and many governmental officials don't seem to care as to anything that they can do in order to reduce that debt, in order to, and also in a way to reduce the tax liability in this country and for all Americans moving forward into the future. Now, if you take a look at the federal tax revenue, that's a revenue that the U.S. government brings in every single year. As of today, is sitting at $3.3 trillion. So we're bringing in, through taxes and other sources, we're bringing in, the U.S. government is bringing in approximately $3.3 trillion. But our federal spending is $4 trillion. $137 billion. So in other words, we're bringing in $3.3 trillion, but we're spending $4.1 trillion. So in reality, we're actually overspending by $835 billion a year. So in the very near future, we're going to be approaching a $1 trillion deficit between what we bring in as a government every single year and what we're spending out in the marketplace. Now, I think the big question for all of us is, okay, so we're actually spending more than we bring in. Now, can you imagine running your household that way? You're bringing in $10,000 a month and you're spending $15,000. You know, how long do you think that you and your family and your business, if your business is bringing in less than what it's spending as far as budgeting is concerned, how long do you think that you and your family and your business are going to be able to survive? Now, what are some of the largest budget items that we see moving forward for the United States? When it comes to, Medicare and Medicaid, it's about $1.1 trillion. Social Security, it's about $992 billion. The amount of money that we spend every year toward defense has just been increased to $672 billion. Income security is about $295 billion. The net interest, that is the interest that we're paying on the debt, that's what is costing us to service a debt today. It's at $331 billion. Now think of it this way: for the last 10 years, interest rates in the United States have been fairly low. So we have been able to use a little bit of leverage in order to pay the interest on the debt every single year. But as interest rates continue to rise in the United States, the amount of money that is going to take to service a debt is going to be a lot higher than the $331 billion that we're spending now on an annual basis. Now, the federal pension system, obviously, that's an additional liability to the federal government. That is sitting today at $263 billion. So the outlook for the United States of America from a tax planning perspective does not look very good. Yes, I know that in December of 2017, last year as a matter of fact, President Trump signed into law a reduction in tax brackets and an increase in the standard deduction. So they did what is known as the Tax Cuts and Jobs Act. I think the challenge with that is that, at the end of the day, it's supposed to sunset in 8 years from now, so we're in 2018. So all of these tax benefits are going to be sunsetting no later than December 31st of 2025. So on January 1 of 2026, everything is going to go back to the old law that was in effect in 2017. Now, the challenge with all of these tax cuts and so forth is that the Democrats have just taken over the House. And one of the first things, because they have been very public about this, and they have publicly spoken about some of these issues. The first thing that they want to do is they want to start raising taxes on the top 1%, and then most important, they want to start raising taxes on the business owners and small businesses and large corporations throughout the United States. I think one of the challenges that we need to be able to understand from a business perspective, and this is my personal opinion after almost 30 years of studying and reading and being involved in economics and financial services and planning for all of those years, is that corporations don't pay taxes. They're actually collectors of taxes. And what does that mean? Well, that means that if you start raising taxes on corporations, the first thing that's going to do is that's going to have a negative impact on the economy. And it's going to have a negative impact on the economy because obviously since more money has to be paid out to the U.S. government in the form of taxes, that means that companies are not going to be buying as much inventory as they did in the past. They're not going to be hiring as many people as they would under the new tax laws. And most important, what the vast majority of these companies are going to do in order to survive the increase in tax liabilities to them is that they're going to be passing on that tax liability to the consumer. Because I'm a small business owner myself, so now obviously I'm in financial services, but if I owned a grocery store, and every other grocery store that I compete with is going to have their taxes raised, the first thing that I'm going to do is I'm going to pass on that tax liability to the consumer. So if you're a consumer and you go into my store and you're going to purchase milk or bread, I'm going to be increasing the prices on those items and just about every other item that I have in the store in order for me to cover that additional liability. Now, what's even more important is not only the fact that you're raising taxes. One of the things that some people are thinking about is why not increase the minimum wage as well, and that creates all kinds of other issues because usually people that are just getting out into the marketplace to finding jobs are the ones that are going to be paying the price because if I have to pay more money to my employees from a business perspective, then I'm either going to reduce the number of employees that I'm going to keep on my books on an annual basis, or I'm going to kind of reduce the hours that they're going to be working. That's one issue. On top of that, if you raise, everyone is talking about bringing the salaries or the minimum wage to $15 an hour. It's not just $15 an hour, because on top of those $15 an hour, you need to be able to also pay payroll taxes and Social Security and so forth as a tax liability, of which the employee pays 50%, and then the employer has to match that 50%. So when it comes to truly understanding the economics in this country, you also have to look at the economic conversation and the economic decisions that are being made, and also the economic proposals that you're seeing, coming down the pike. You have to be able to look at them through a telescope as opposed to a microscope. One of the final numbers that I want to discuss with all of you today is that although the national debt is approaching $22 trillion, and although that we have almost $1 trillion of federal budget deficit between what we bring in as a country and what we pay out, but also we need to take a look at the unfunded liability that we have in the United States. Now, when you take a look at the unfunded liability for Social Security, Medicare, Medicaid, Medicare Part D, and even the interest on the national debt, that actually is right now at $115 trillion and counting. Now, you would say, well, Bert, what is the unfunded liability that you're talking about? Well, the unfunded liability is primarily all of those promises that the U.S. government has made to its people, to all Americans, that they don't have the money today to be able to forecast and to be able to pay. So, for instance, the tax liability right now, or the unfunded liability, although for Social Security it'll stay at $17 trillion, and for Medicare, which is even a bigger problem than Social Security, is sitting at $27 trillion. That only means that if the U.S. government had $17 trillion in an account today, just to mitigate Social Security liability in the future, and then obviously earning interest on that money, and $27 trillion if they had it in a separate account, $27 trillion in order to cover Medicare liability, and that money would be there earning interest on behalf of all the Americans, then we would be okay when it comes to Social Security and Medicare. The problem is that money is non-existent. There is no $17 trillion in the Social Security funding mechanism. There's no almost $28 trillion in Medicare liability set aside, earning interest to be able to pay our debt as we move forward into the future. So because of the fact that the money is not there, then the unfunded liability for all of these vehicles is actually exceeding $115 trillion today. And that can only get worse. Now, obviously, at some point in time in the future, someone is going to have to pay the piper. So the big decision for all of us and for all of you is when will be the time when the government is going to say, there's not more that we can do here. We're not going to have a choice but to start raising taxes, and more than likely it's going to have to double the taxes at some point in time in the future. And that's something that's going to happen in the very near future. Now, no one knows who's going to be in power. In 1926, obviously, depending on who's going to be in power will determine what's going to happen. But I think the big challenge for all Americans is that our government are continuing to push and kick the can down the road. And when you kick the can down the road, you can only do it for so long, because eventually somebody is going to have to pay the piper. Now, most of you may not know this name, but there was a gentleman by the name of David Walker. He's still alive today. He's an economist. And he was the Comptroller General of the United States under two administrations. And he left government in 2008, almost 10 years ago to the day. And basically what he said before he left government, he said that in order for our country not to go bankrupt in the future, taxes would have to double, because otherwise, unless we double taxes, then our country was going to be facing bankruptcy, similar to many other profitable countries that have gone through challenges in the past as well. So that brings me to the point of who's the only person and who are the only people that can manage and protect the tax liability that we live in today, and the tax liability that we may be facing in the future. It's not going to be the U.S. government. It's not going to be the companies that you work for. It's not going to be any nonprofit organization out there in the marketplace. It's going to have to be each and every one of us. So the more education you are and the more information that you receive. Now, I always say this, that information without education always leads to failure. But at the end of the day, it is incumbent upon you and your family and your business to make certain that you protect yourselves from any future liabilities that you have coming to you. Now, over the next couple of weeks, although we've talked about the 3 taxable buckets in the U.S., the taxable bucket, the tax-deferred bucket, and the tax-free bucket. Although that's the case, I think the more that we understand and the more that all of you understand the features, the benefits, and the things that you need to do in order to minimize and or eliminate your tax liability in retirement on a guaranteed basis, the better off you're going to be. Now, obviously, there's a difference between tax avoidance and tax evasion. So whenever I do tax planning for my clients, I want to make certain that we can legally avoid as much taxes as we possibly can. But by the same token, it is incumbent upon all of you not to just pay your taxes every year and not to just do tax preparation, but also to make certain that you educate yourselves and that you do due diligence to make certain that you can also reduce your tax liability to as close to a 0% as you possibly can. Now, when it comes to making certain that you can do that, obviously the more time that you have on your side of the ledger, the better off you're going to be. And if you have anywhere between 5 to 10 years away from retirement, there are a lot of things that can be done. If you happen to be already in retirement, well, you're a little bit late to the game, but you can still avoid many of the tax liabilities coming down the pike in the next 8 years. If you actually start working on your personal economics and your personal tax liabilities today. Remember, we do have, based on what we see today, we don't know what's going to happen in the next few years, but at least for the next 8 years, we're actually living in the third lowest tax bracket from a historical perspective in the history of the world. So there's a very, very high probability that taxes are going to have to climb dramatically. And the challenge for most of us is that unless you've been a financial failure for your entire life, there's a very high probability that your taxes in retirement are going to be a lot higher than they are today because, by the same token, some of the deductions and exemptions that you could take today on your tax returns, you're not going to be able to take in retirement because they're going to be gone. So even if tax brackets were not to increase in the future, which I am certain that they will, your tax liability, your personal tax liability may increase because of the fact that you're giving away all of those deductions and exemptions. So again, today I just wanted to take a few minutes of your time and share with you why it is that I continue to think that taxes are going to be a lot greater in retirement and why taxes are going to have to increase in the future. But I wanted to give you some actual numbers for you to ponder on and also for you to truly understand and to start acting upon all of those issues as soon as you possibly can. So we're getting to the end of 2018. You still have time to do tax planning. Make sure that you go back to your tax preparer. Now, obviously, if you're not comfortable or if you don't think that he or she will be able to help you with tax planning as opposed to just, tax preparation, well, feel free to reach out to me. You can reach out to me at 786-766-1042. Again, 786-766-1042, or you can send me an email, and you can send me an email at Gable's Tax Planning Group, and the email address is Bert, B-E-R-T, at gablestaxgroup.com, and we can schedule a call. We can schedule a video call. We can schedule a conference call, and I'll be more than happy to answer any questions that you may have. Obviously, there's no cost or obligation to schedule a call with me, but at the end of the day, as a retirement strategist and as someone that works very diligently when it comes to tax planning, is something that is incumbent upon all of you to make certain that you act upon it today, because the definition of insanity is doing the same things over and over again while expecting a different result. And then last but not least, always remember, and this is something that I share with all of you every single time and every single day that we do a podcast, is that my number one goal in life is to be able to help you and all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks for giving me a few minutes of your time. Happy holidays to all of you, and we'll talk again next week. Take care. Bye.
Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.